All right, folks, trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So folks, just generally speaking, only fund a futures account with risk capital. If you're unsure where you fall on the risk capital curve, so to speak, please feel free to have a discussion about that with your representative in our office. Everybody here has one, whether you're a customer of Infinity or not, okay? Now, this particular event, we're going to talk also about some hypothetical trade results, some testing that I've done. Just bear in mind that these trades are done in a simulator, and just like every other simulated trade, hypothetical data has limitations in terms of its effectiveness or usefulness. So please don't, forget about that. And make sure you read this disclaimer. And again, if you'd like to have a discussion with us about the differences and how this comes into play when it comes to real money, of course, we would be happy to have a discussion with you about that. Okay, that's an important note to make. But if you ever have any questions about risk, one of the things you'll find about Infinity is that we're very straight shooters when it comes to discussing risk objectively. And we're happy to have a discussion with you individually about your situation to see if this type of trading is appropriate for you. All right. So let's go ahead and get started. I'm going to pause this screen for 1 second here, and then I'm going to bring the screen up again, and we're going to go ahead and get started. Here we go. Okay, so just a little bit of quick background. My name is Patrick Zielbauer. That's a picture of me, my family. I've been registered with Infinity since 2004, and I always like to mention that because there are a number of other employees that work for Infinity who have been with this company for years and years, 7, 10 plus years. I find it to be an anomaly in our business that a number of salespeople, support people, customer support people have been with the same firm for so long. I think it is indicative of the culture and the stability of the company. So I always like to mention that. I was 21 years old when I got hired here, and I'm 36, been here for 15 plus years. I'm located in Austin, Texas. The company, as you know, probably is headquartered in Chicago. So I am technically a branch of Infinity Futures operating out of Texas. And I have had contact with thousands of traders over the last 15 years. That includes people who've had accounts here, people who currently trade here, people who I've talked to on the phone about trading or via email, prospective clients of Infinity. And as a result of that, just the sheer number of interactions that I've had, I definitely have a unique perspective into the minds and behaviors of traders. And I think that that's a really important thing to note, because unlike, for example, in the education space, where you might be following videos or chat rooms and such, the perspective that those folks have is a lot different than what I have, because I get to see what people actually do and how they actually behave, not just what they say they do or how they say they're going to behave. I believe there's a dramatic difference there, and I think it's quintessential into understanding how valuable it is to have a partnership with the firm that you trade with and your broker that understands that. And so we're going to get into that a little bit more as we go. And I'd like to mention that I've never sold any indicators or classes, just Infinity services. So we work with a number of outside groups who have written indicators into our charts and that sort of thing. And sure, we've always helped and supported people who want to use that stuff. But as a company, we like to focus on what can be used inside our program by anybody who's a customer, without having to rely on an outside party. All right. So when I say that I have seen a lot, being on this side of the business, I think that there are a few things that traders just in general have an issue with. And I'm not just going to use the same, can't follow your own rules, overtrade the account. I mean, everybody knows that, right? Those are obvious. I think that there are a few specific problems that people have and have to be acknowledged before a trader will understand, or even have really a chance to turn the corner, so to speak. Okay, and we are recording the event, Gashi, and a few other people were asking that, so we'll have it posted here soon. All right. So here are the specific things that I think cause problems. And this sort of leads into what we're going to go to next. Okay. It's the number one is the lack of respect for the leverage that is employed. And I say margin question in quotes. What I mean by margin question is, hey, Patrick, what's the minimum I can open with? What's the lowest margin you got? When I get asked that question, I understand why people are asking. It's because they, in theory, want the best deal. But there's usually inside of that question, being asked that question tells me something about the person asking me the question. And that usually is that this person cares about employing potentially dramatic amounts of leverage. And what I have found is that most of the people who you want to employ dramatic amounts of leverage either are brand new or just have not been through the meat grinder yet and just don't understand what they're getting into. So that's why we're so hesitant to just blast out, information about margin requirements without very clear disclaimers about what day trade margin means. Day trade margin does dramatically increase the potential for you to lever up, which obviously is a double-edged sword. And I think that there's just an overall lack of respect for the amount of money that each of these contracts represents. We'll talk about how the micros come into play a little bit. But for example, the S&P right now is trading at 29.80, give or take, right? 29.80. So does anybody here just kind of know off the top of their head, sort of randomly, what that means in terms of what the contract is worth? Anybody here sort of, could just throw out a number? If you see the S&P at 29.80 and I were to ask you, what's the contract worth? What does that mean to you? Okay, so a lot of people just don't know how to answer that question. And the answer is to take $50, which is the point value, multiplied by the value of the contract, which is $144,000. So when you ask me, Patrick, what's the lowest margin you got? That's totally fine. We want to be flexible and competitive, but we also want you to understand that if you trade with $500 margin, that means you're taking a position worth about $144,000 with $500. So is there any other business that you would use that kind of leverage in? Probably there's not many. I mean, at least that I can think of. So most people don't even bother to do this math. And I think so they just it's not their fault. It's just, they're not taught to do this. So no one ever just right out of the gate understands, wow, oh my God, I'm using, quite a bit of leverage here. There's no wonder why this is so difficult. When I make a mistake, it's so expensive or costly. So I think that understanding and having some respect for the leverage that's employed, puts things in perspective at the very least. Okay. The next thing is the rewarding of poor decision making. So it's kind of like training a dog. Okay. No offense to anybody here. I'm not calling you a dog, but I've made these same mistakes. If you break your rules and then you make money as a result, what do you think is going to happen the next time you have an opportunity to break your rules? I mean, you're going to break the rules. All right. The best example I can give is, when people sort of blindly average in or double into positions, right? They dig their way out. Market comes back in their favor a little bit. They make money on the trades solely because of the fact that they averaged in. They feel good about it. Next time that happens, they make money again. And then maybe they make money 4 or 5 or 6 or 10 more times. And then on the 18th time, they blow out the whole account in one day. Okay, it's a bad habit. But the problem is that given that you're in your home or your office, you're not working for a prop trading group with your employer looking over your shoulder. You don't have anybody enforcing the rules. So how can we expect you to on your own without any kind of help enforce the rules? It's really, really hard to do this without some help. It's like, the best example I can give is, I like to run. Okay. I've run a couple marathons and, something I've done my whole life, but it's a lot easier for me to run faster around a track when I have a coach timing me, when I'm being told if I'm doing good or bad, than if I just feel like going to the track myself and, trying to run around and run a few laps. I just can't do it as well. So I think that this is a problem that is really hard to fix. This is one of the things that's really hard to fix. It's one of the places that Infinity's risk system, rather our parent company's risk system, Transact, has the ability to sort of help you keep in line. Maybe we'll talk about that a little bit later, but I think that's a major issue. That kind of leads into the next thing about the lack of positive reinforcement. Trading rooms are good for community. They're good to satisfy boredom and loneliness. They try to fill the void to the extent that they can, but the problem is that you don't know who's telling the truth. You don't know if the people you're talking to are really doing what they're saying they're doing. There's kind of this fear of missing out thing that happens. I'm going to talk about that a little bit later. That this is a major issue, another one that is hard to fix. Okay, another one, technology and excess information. So I got into a little discussion with a customer the other day about some sort of not obscure, but a kind of a feature that they were looking for that maybe we didn't have in the place that they wanted it to be, and we sort of got to talking about it. And to me, it was just nonsense. It was excess information. This particular customer was sort of using it as a reason why they were struggling with something, and I don't buy it. I think that what happens is as technology gets better and we have access to more and more excess information, we seek explanations for why we can't do things. We seek reasoning. So we seek out extra information. We seek out more indicators. And this information comes at us faster and faster every day. It's never going to slow down. And we are determined to interpret all of it. I think that is a major problem. I think that trading is a great example of an industry where more often than not, less is more. Okay, that's my opinion, but it's based on a lot of experience. And then the main thing that I think is actually really controllable, which we'll talk about in a little bit, is what I call the inability to sacrifice open trade equity. Okay, what I mean by that is you're in a position, it's in your favor, you feel pretty good about it, you start to have this fear of giving it back, and you end up with a 3-tick trailing stop. You take yourself out of the trade for no reason, and then the market waits like 30 seconds, and then it runs in your favor another like $500 without you. All right, the inability to sacrifice open trade equity is a big problem for retail traders. And that is actually something that I think can be fixed. And I think it's a huge part of what we'll be talking about today. And I think it's, of all these things, it's besides the math question about the leverage, I think that it's one of those things that regular people sitting at home can learn to do this. All right, so we'll talk about that as we go. All right, so what I have always asked myself is, what can I do? All right, I need my customers around. I need my clients to trade. I can't have them in a simulator for a year. I can't have them talking to me for 2 years on the phone, opening an account, and then blowing out the account in 2 weeks, and it's a huge waste of time for both of us. What can I do from my side? So I am constantly seeking longevity, okay? One of the things I love about talking with my customers and doing these sorts of events is that I can encourage people to just let your guard down. I'm not going to sell you a magic bean at the end of this deal, right? Everything that I will put in front of my customers is geared towards keeping them around as long as I can. All right, for some people that is going to be indefinitely. Hopefully some of those people are able to turn the corner and make money. All right, but the idea is that I need people to be at this long enough to have enough screen time where they can go through the ups and downs, deal with the changes in the economic climate, deal with the changes in the volatility climate. I want to play the long game. So I'm constantly seeking out trade ideas and strategies that promote that idea. So it's really, I hope it's disarming for you in a way where you know that the stuff that I'm putting in front of you, I would not put in front of you if I didn't believe that it had a chance to help. So anyway, that's what I was thinking. That's what's going through my head. All right, now MPD lines. We'll talk. We're going to go in greater detail about this, but this is basically what MPD lines look like. Okay, you have a VWAP in the middle. That's the white line. You can customize the colors, and then you've got two other lines. Some lines at the top and the bottom, which are in red. That's called the maximum permissible deviation, and then you've got these blue lines in between those two levels. So those are what I refer to as the middle or upper mid and lower mid MPD lines. And effectively, what an MPD line is, maximum permissible deviation line is a VWAP in the middle, volume weighted average price, and then lines that represent a portion of the day's range added to and subtracted from the VWAP. So it's basic math. We'll talk about anchoring and some things in times in just a minute. But the general concept is that if you have a wide range, you're going to have wide lines. If you have a really narrow range, you're going to have narrow lines. You'll notice that as this day goes on, in this example on the screen, the lines get wider because the range has expanded. Okay, that doesn't always happen. If the range doesn't expand in the afternoon, then the lines will stay closer together. So it's kind of got a Bollinger-like feel to it, but it's not an oscillator. It's not using some mysterious formula. It's solely based on range and volume-weighted average price. And as the VWAP trends in one direction, so will the MPD lines. Okay, that's the general concept. So choppy range-bound markets are not all bad. So it's funny, I'm sitting in the different chat rooms and listening to people talk and such, and there's always chatter about choppy markets. We're in the middle of the chop and slop in the middle of the day. It's too choppy. There's no trend. Chop, chop, chop. Can't do anything. Chop, chop, chop. Choppy markets are not necessarily bad. Okay, this is from a couple of days ago. I think the 17th is when I made this picture. I have a lot more current stuff coming here, but MPD lines are basically reversion to the mean lines. If you find yourself in a market where you don't have a distinct piece of news, you don't have an economic report right around the corner, which I know is difficult because there's so many, but if you find yourself in effectively a dead spot, low volume, when the market does move, you don't see spikes in volume, the market is relatively slow, you can start to look for opportunities to fade these little moves. A lot of times I will start looking at the MPD around 2 or 3 in the morning. It doesn't mean I'm always staring at it at that early in the morning, but I usually will ignore everything before that because there's just not enough activity during the Asian session, usually volume-wise, for me to care. Around 2 o'clock Central, which is when you have like the London opening, then I will start to think, okay, if somebody were up, looking at this, that there's validity there. And basically, when you look at a chart with MPD lines on it, if things are working the way that I see them usually tend to work, is you're going to see some flurries of activity around those extreme areas. If you are more aggressive, or if you have a bigger account, you don't mind getting in a little bit earlier, you can look for fading opportunities at those middle lines. On the charting program, AT charts, which we will continue to talk about, you could disable the middle lines. If you feel that they're a distraction, or if they tempt you too much where you're getting into these trades a little bit too early, you could disable them. That's perfectly reasonable. A lot of people will just use the outside lines. And this will lead into our discussion a little bit earlier about trying to keep, or a little bit later about trying to keep the trade frequency low. But if you are looking for fading opportunities, if you don't mind a little bit of counter trend trading, if you don't mind selling strength or buying weakness, if you are judicious with position sizing, I think this is something that you could employ. Again, we'll give you some more current examples here as we go. All right, and again, the little stars I wrote there that said chat room example, what I meant by that again was earlier, when I hear the commentary about trend, the lack of trends or choppy markets, it makes me, I'm not going to say it's frustrating. It's not frustrating. It's just there are opportunities even when the markets are slow. All right, this afternoon, after things were rebounding a little bit late in the day, there was a lot of dead space, between I think about 12 o'clock and about 2:30. It's not like you're going to find fading opportunities every day. Okay, this was extraordinarily slow this afternoon. I didn't see a whole lot going on, but a lot of times when things are quiet, you can still, take part. Okay, choppy range-bound markets are not always all bad. So sometimes what I like to do when I'm going through the markets in real time is I take notes about these hypothetical trades that I put on. So I'll actually put these trades on, and I know it's a simulator, so again, there are significant limitations there, but I like to do it in real time because it helps me hold myself accountable. I also like to draw on the chart at the time when I had the thought, so that when I come back later, I can see how the market moved in relation to my drawing, and then I can say, okay, I had the right idea there, or I could say, wow, I was like super wrong. And so that's an accountability procedure that I like to go through. So in this example here, you can see examples of the market bouncing and creating these channels, which basically create themselves. I was looking at the channel drawing tool, inside AT charts, and I thought about it for a second, and I realized, this is actually just today, and I realized the channel drawing tool is really, you don't even really need to draw channels because the MPD lines will create them for you. You can see it happening, here on its own. So what I was basically looking for in this example was the market to find some resistance around the VWAP, because sometimes the market will bounce off of that VWAP line. That's that middle white line. And I was willing to buy back the short or make a new, make a new long position based on this half MPD line, because there was just no conviction, and the market was moving very, very slow. So there are some examples here of buying and selling these micro E-mini contracts, not very actively, just a couple contracts here and there. And there are examples of me, like in this case here, looking for fading opportunities that were never hit. So I remember thinking at this moment, I'm going to draw this little circle here because I want to see the market rally back up to this area. I'm willing to fade that new high just as it sucks up all the long people who are going to get long right here because it's going to breach this new high. So I remember thinking the other markets don't look very strong. The market's going to rally above this recent high. It's going to suck all these people into longs, and then it's going to break. So I was that was my thought process. So we didn't get there, but we did get there later, and I actually did add to that position, and then we did see the market tire out in the latter part of the day. And this is an example of a trade where there's not a ton of trading activity, and there's no scalping occurring. There's no hyperactive sort of activity occurring. There's no if this and this line up for like 1 second, that we got to get in, but if we don't get in right that moment, screw it, we can't take the trade. I want to try to shift people away from that method of thinking unless you really feel like you can make that kind of trading work. I believe that some people can. I believe that most people cannot. All right, there's a degree of introspection you have to do, to decide that, and probably some experience. But what you will find is that if you can scale back the frequency with which you are trading, or you can combine judicious position sizing with this style of trading, I think that you can make better decisions. Okay, this 6 MES contract position here was 1, 1, and 4. Okay, this is judicious scaling. This is me saying, okay, look, I know that I'm probably not going to call the top here. I know that I'm probably not going to call the top here. And if the market breaks up to 29.99, I'm willing to weight the higher end of the range a little bit heavier so that I can get a better average price. That's not the same thing as blindly averaging into a position until my account is at 0, right? That is a very controlled way of looking at the market. All right, these levels are there, these numbers, these values are there in advance. The orders are on the dome, 1, 1, and 4. And even if they all get hit, that's only a 0.6 E-mini S&P position. So if the market does run, higher above 29.99, I'm only in a short 0.6 E-mini S&P position. Most people here are going to be able to tolerate that. Okay. There's a question that came through from Gene about what is your favorite time frame for the MPD. That's a great question, Gene, because the answer is it doesn't matter, because these numbers are the same either way. The numbers are the numbers. It doesn't matter if you're on a 1 minute or a 5 minute. I look at 5 minute charts solely out of convenience. It shows because my candles aren't too narrow or too thick. I can see as far back as really I want to go, but the numbers are the same either way. All that matters is the VWAP and the range. So those numbers are going to be the same regardless of the time frame you choose, which is why I think this is awesome, because it encourages pre-planned staging of orders based on price levels and context rather than like eyeballing specific indicators and making quick decisions. That's where I think people, really falter. Okay, so it doesn't really matter the time frame. That's more just going to be personal preference. All right, Arturo, in terms of what's the difference between this and a Bollinger Band, I don't really know the formula for Bollinger Bands, so I wouldn't be able to tell you. I mean, I know that as markets get more volatile, Bollinger Bands expand, but I don't actually know what the actual formula is for the Bollinger Band. But with the MPD, it's just half the day's range plus the VWAP, and then half the day's range minus the VWAP. That's it, or subtracted from the VWAP, and that's it. So very, very simple. Okay, so I'm gonna post a YouTube playlist in a little bit. I'll do it at the end of the presentation. I made a YouTube playlist last week that it looks like this. There's a bunch of stuff that I've put together. I'm going to update this about once or twice or 3 times a week if I can. We're going to talk about, I call it Patrick's Corner Real Talk for Traders. So these are going to be responses to questions that I get. They're going to be updates to our software, questions that people are asking about the program, trading ideas. One thing I've been doing is I've been tracking these trade ideas in real time throughout the day. And so I create these videos where the video might span a course of like 6 or 8 hours, but really the video is like 10 minutes long because I'm just, I'm putting the recording back on when I'm doing something. So if you want to get access to trade ideas and platform tips and news from us and such, please feel free to subscribe to that. Obviously, it's free. It's a YouTube playlist. And whenever we post an update, you get a notification on your phone or your email. So that's a great way to stay sort of connected. Of course, it's free. The example, I say here, the S word example, that was this S talk. This was a discussion that I had with a couple of customers about slippage. Slippage. Well, Patrick, I'm trading the NASDAQ. Why am I getting, 2 ticks of slippage? Why did I get 5 points of slippage that one time? These are legitimate questions. And it was important to address them for this particular customer. And I thought it was a good idea to address them for other people as well. It had to do with lack of liquidity, volatility, the combination with rollover and the order book being super thin. These are the kinds of things that people should understand. And this is a good way for me to communicate, to people on a larger format. Okay. So I'll post the link to that here in a bit. All right, so only you know your risk tolerance. So whenever you're going to explore the idea of counter trend trading, and this is not entirely devoted to counter trend trading, okay? There are examples as early as today that I can give you about how MPD lines can actually help you in trending markets. But if you're going to explore the idea of selling strength or buying weakness, you need to be honest with yourself about your own weaknesses, okay? Counter trend trading is simply not for everybody because you have to be willing to be wrong. All right, you have to know how to cut yourself off. You have to have some sort of predefined risk amount in your mind that represents maybe like your worst possible day in terms of risk. Okay, you really need to be honest with yourself about whether or not you can handle that. And if you can't, put yourself in position to try. These are these are skills that can be developed. But don't buy the idea that only trending markets are tradable. Keep an open mind. An MPD, as I tell you here, can help with both trending and choppy markets, and trade with your capital structure and sanity in mind. That I'm kind of alluding to the presence of the micros here. I have beliefs as to the way that these micros can be employed by folks. We're gonna talk about that more as well in some more examples. Okay, so just in general, these are the reasons why I believe that these sorts of lines, they're just lines. I mean, they're just lines, right? I mean, this is not magic. But why do I think that incorporating this into your process could be useful? Okay. Trying to keep you out of the middle of the range. Sometimes when I talk to customers, they call me up and they're like, Patrick, I'm looking back at the chart that I just traded through. What was I thinking getting mixed up in all that muck in the middle? There's nothing there for me. That is a common thing. And whether or not you've had that conversation with me, there's probably been times where you've thought that. Okay. The idea with these bands is that you can keep out of the middle of the range. You can reduce the frequency with which you trade because these bands don't get hit that often. You have to wait. Okay. This has the ability for you to reduce those intraday stop outs. Okay. If you're trading, 3 lots of the E-mini S&P with a 6-tick stop, sorry, but that's really hard to do. All right, and it can be an expensive process. I would argue in many cases that if you're going to risk that amount of money, that you're better off doing it on 1 or 2 trades rather than doing it all day long and doing 75 round turns also. Okay, what you'll notice is that around those extreme areas, this is a concept that I did not coin. That's called trading around the edges. I don't even know where I heard it, but trading around the edges, you will often see a flurry of activity at that around those levels that can create opportunity. So a lot of times what you see is you see the market reach one of those extreme areas, and then that all your counterparts, the retail traders who were long or who were short, they're gone. A lot of them are gone by then. They're blown out. What normally happens after you get stopped out of a trade, Mr. and Mrs. Jones, listening to this webinar? All right. What do you feel like happens right after you get taken out? right back the other way without you, right? That's what you want to think about. You want to think about, okay, what happens to me usually? That's probably what happens to a lot of other people as well. So if you have the patience to wait until those extreme areas are reached, and there's a strong likelihood that all the retail business has been blown out by then you may have a chance to catch something as it runs back the other way. That's what successful counter trend trading is about, in my opinion. And it does require patience. And again, by the time the market reaches those areas, there's a good chance that a lot of other smaller traders are forced out of the market. And this is going to force you to be patient, because there's going to be waiting around. I mean, this afternoon was a good example. There's just not that much going on until around 2:30, when there was, I think, a little bit of a spike. This is going to force a degree of patience that you may not have thought you were going to have to learn how to deal with. In response also to Gene's question, time frames don't really matter, since the levels are the levels. So looking at 1 minute chart doesn't yield different values than looking at a 5-minute chart. If you look at a 1 minute chart, you're going to get more candles, and you might be tempted more often. So you may argue that looking at a little bit of a longer time frame might be a better place to start. But time frames on their own do not affect the mathematical output of where the lines are. So the levels are the levels. Okay, this is a big one. Order staging, pre-planned trades. Order staging is to me the real life implementation of patience. When you stage orders in advance, doesn't mean you can't modify or cancel them later, but order staging is a manifestation of you having a plan. And you can stage orders based on these levels, especially with these micro-sized contracts, and just wait till they get hit. It's not very reactive. Now, there are situations where these lines shift throughout the day, because the VWAP will shift, and so the lines are going to shift with it. So you may be adjusting some stuff, from time to time, but there's a degree of planning that is sort of disarming and relaxing, because you don't have to sit there with your finger on the trigger, waiting for something to happen. And this encourages you to have the ability to walk away. So, I'm not a big fan of leaving futures positions unattended, just in general, because of the leverage and the risk of doing so. But the idea is that if you have a couple of these on, especially with the smaller contracts, and we're going to talk about this in greater detail, catching a runner from time to time is necessary in order for people to have the satisfaction to keep at this. And you can actually walk away from these kinds of trades and come back in a few hours, or come back at 3 o'clock Central and manage your position. So we're going to talk about some examples of that. Joining trends is still possible. As I mentioned, it's not solely directed towards counter trend trading. There are opportunities using MPD lines that are also for trend followers. We're going to talk about that too. And again, losing sucks, but losing in certain ways is way more debilitating than others. Getting stopped out of a 3-lot or a 4-lot with a tight stop 10 or 15 times in a day, or even 5 times a day or something like that, that is a debilitating issue. If you are just wrong because you had a judicious size position, and you had a nice wide stop that represented sort of like your max risk tolerance, and it gets hit, you're much less likely to have been the bottom, right? Because statistically speaking, as the further away you are in terms of your stop, the less likely you are to be the very, very bottom of that move. So if you're just wrong because you just were completely wrong, then that's not fun, but it's better than getting tagged out and having the market run the other way without you, 30 seconds later. So I think there's a difference in the way, that you lose that can affect your ability to follow, the game plan the next day. Okay, so things to look out for when it comes to counter trend trading. There's a bunch of questions that came in. Some of these things I'm about to cover, so I may not answer them all, but we'll take more questions, as we go near the end as well. Okay, things to look out for when you're counter trend trading. All right, economic reports and Fed speak. I use a economic report called Econo Day. You just Google Econo Day economic calendar. You'll find it. It's pretty clear. It shows Fed speakers. It shows the oil reports. It shows all the interest rate announcements, the T-bill auctions. Just generally speaking, you know when this stuff is. Okay, that's something you can control. All right, Trump tweets. All right, I mean, you could do about that. It's just going to happen. Brexit news, same deal. I mean, we know when the meetings are happening, we know when the announcements are happening usually, but there are certain elements of this that you just can't, you can't mitigate certain risks. Okay, one thing to look out for when you're establishing an idea that is counter trend is to look to see if all four of the major indexes are making concurrent new highs or lows. So generally speaking, with MPD lines, I see more positive outcomes in my own study when the indexes are disjointed. So if all four of the indexes are making a new high and all four of the indexes are up 0.25%, that is not a market I would want to typically fade. Okay, because there's no disjointedness between the indexes. What I generally find is that if the Russell's down a little bit, and the S&P's up, and the Dow is down, and the Nasdaq's up a little bit, that's usually when these things feel a little bit mishmashier, and the likelihood for the market to revert to the mean because there's just no conviction is a little greater. So if you find a situation where the major indexes feel disjointed, I think that can take down one barrier towards that is between you and putting a position on. Okay, so I'm usually looking for, that's how I frame things in my mind, is I look for barriers. Okay, what would stop me? Okay, well, if the non-farm payroll is in 5 minutes, that would probably stop me from putting a trade on now. Okay, that's one thing. If all four major indexes are all in lockstep and they're all making a new high, that's probably not a market I want to sell. In fact, that could present a trending opportunity in the other direction, which we'll continue to touch on. Okay, an extreme move in a major commodity like crude oil or the dollar. So if you are looking at crude oil is the best example I can give because of what happened over the other weekend. Just be aware. I mean, just awareness. I mean, if there is a major move occurring in some relevant currency or commodity, just understand that could give some extra oomph to whatever move is currently occurring that you're trying to fade. Okay, so just be aware. Be aware. That's not something you can control, but you can control whether or not or how aggressively you enter a position based on something like that happening. Okay. One thing to note is careful going heavily long the E-mini S&P if the Nasdaq is really tanking. There's a lot of tech companies in the S&P 500, a lot of big ones. There are more than one sort of people there are more people in the education space that I've picked that up from than basically any other basic fact about two different indexes and how they relate to each other. Okay, that is a commonly espoused idea. Just be careful if with the S&P if the NQ is really tanking. The other conversely, the E-mini Russell future, the Russell, today was the loss leader, right? It was down 1.1%, whereas the S&P I think was down 0.2%. I rarely see the Russell pull the other markets out of the downside. So if you're looking for a fading opportunity, the Russell tends to be one that I would fade first, because if the Russell rallies and the S&P and the Nasdaq don't follow, which they usually do not do, then there's an easier, in my opinion, fading opportunity with the Russell. So the Russell is one that you could always, that you should always look at. The other reason why I like when people look at the Russell is that the Russell is the smallest of the four indexes in terms of cash value. So you can use a wider stop in the Russell and not risk more money, because it's a small contract. It's trading at what, 1536 right now. Okay, so 1536, and every point is worth $50. 1536 times 50 is $76,800. So as opposed to the S&P, you heard me earlier, was about 144,000. The cash value of the Russell futures, even the regular size Russell, is about half of that of the E-mini S&P. So if you're looking for an index that's like bigger than the micros, but you don't want to trade something like the S&P or the Nasdaq because you're not there yet, you may want to look at the Russell. Okay, and then also, today was a great example of this. Consider skipping the first 30 minutes between 8:30. That should say 9 o'clock. Sorry about that. The first 30 minutes between 8:30 and 9, unless you trade lightly enough where it doesn't matter if you get caught in a quick move against. So if you put a trade right on at 8:30, a lot of times, you'll see, a lot of volatility in that first half hour. Sometimes in the first 10 minutes, feels like the market's already made up its mind, for the next 2 or 3 hours. I think I have a screenshot of what I mean here. Yeah, so like this is an example of a downward move right on the open. So as a test, I had put on a couple of micro positions on 4 different contracts and right around the open, scaled in, this is only long about 70% of one E-mini total. So we're talking minuscule dollar amounts. I mean, look at this. So this is one mini Dow, micro Dow, two micro Russell, two micro NASDAQ, two micro E-mini S&Ps. And the dollar amounts we're looking at here right in the open are, I mean, these are so small that most people here won't even care. But if you're going to trade a little bit heavier, or you're going to trade the regular E-minis, and you are going to look for a counter trend opportunity, you may want to consider holding off until some of that flurry is over in the first 30 minutes. Okay. All right. So a couple other things here, diving MPD lines. So remember that MPD lines are based on the range and the volume weighted average price. So if the market starts trading lower and lots of volume is trading, these lines are going to come down steeper. Okay. So a steeper line means that there's heavy volume. If a line has a very deep slope or upward sloping slope, that means that there's heavy volume occurring. If the market is just kind of like, if the line is just kind of barely going up or barely going down, that means that time is going by and trading is occurring, but not necessarily a lot of trading, or at least it's at a, in a narrow range. Once the market starts falling, if it falls on heavy volume, you're going to get these diving lines. So this oftentimes will happen in the very beginning of the session, like it did today. So here, this is around 8:30. The market took a dive right after the open. This is a situation where you may want to consider waiting for the lines to flatten out before you add risk to your account. So a lot of times what will happen with the indexes is the market will move. It will stick everybody who got in early, and then it will establish this new really boring range for another 2 hours. So this is an example of, if that happens and you're not already in the market, hopefully you generally want to wait to see if that lower MPD line will flatten out before you start exploring the idea of taking a long should it be breached. Okay, so that is something to consider. So if you see diving MPD lines and you're already not in the market, then that's an example of, depending on your risk tolerance and the size of the positions that you're thinking about putting on, see if you can wait for that line to flatten out just a little bit. Okay, if the MPD lines don't stabilize, or if the markets are concurrently making new lows, you can actually use this as a way to get back onto the trend bandwagon. So what I mean by this is that if those lines continually steepen, then you can use this upper, like mid-level MPD area here on the lower end actually as a place to get short. So again, if these lines are diving down, which means you have heavy volume trading, okay, heavy volume happening, and your quote screens are going all red. You see all four of the major indexes getting smoked. This really doesn't feel like it's going to end anytime soon. Obviously, it could, okay, and we'll address that. But the idea is that if you're not getting that flattening out behavior, then you have the ability to join the idea that today may be sort of a trending day. And so what do you use to sell the rally? Well, you could use this mid-level lower MPD line as a place to explore being short. Okay, the risk of doing such a thing, which we've seen numerous times, so it's something you want to be aware of, is that you get an immediate algorithmically driven or news driven snapback rally all the way back to even out of nowhere. All right, that could happen too. So that let's not pretend like you're going to nimbly jump into trend trading and be short and the market's always going to fall another 20 points. We don't know if that's going to happen. But if you're looking for a way to be able to have a shift mentally as to, okay, look, this thing doesn't look like it's coming back anytime soon. There is uniform strength to the downside across, four major indexes. Let's look for a place to get short after, all these people, are trying to bail or trying to, force the market up, force the market to go, they're all long. They're trying to bail. And those little pops might be areas where you can be short. So that's how the MPD lines can actually help you in trending markets rather than, just, boring choppy markets. Okay. Yeah. Unless Trump tweets something. Right. Exactly. Yep. Exactly. All right. So this is going to bring me to, one of the concepts I talked about earlier, which is like trying to catch a runner. So I made a comment earlier about sacrificing open trade equity. Okay. That to me is something that most of my customers don't know that they do badly. A lot of my customers know what they do badly. This is typically not one of those things. And it's one of the things I think is still a skill rather that can be acquired. All right. In order to catch a running trade that lasts the whole day or several hours, you either have to have nerves of steel or you can't watch it. If you sit there and stare at it, I can almost guarantee you, you will never catch one. You will almost always suffocate the position and take yourself out way too early. The reason I like the idea of giving back open trade equity as a potentially positive thing is that you effectively have controllable outcomes at that point. Okay, if you put your stop, let's say you do end up taking a counter trend trade and you do find something working in your favor. You put your stop to break even. Don't put it to break even, 3 ticks, after you're in profit. Okay, there's some context here. You want to be aware that we've sort of shifted into a new range. Put that stop at break even and walk away. You basically are going to have one of 3 outcomes. All right, you're either going to get stopped out, or you're going to come back and the market is going to be where it was when you left, or you've got a runner on your hands that lasted the entire time you were gone. All right, there's not much else that could happen in there. Maybe you have a small, if the market's floating around, you have a small winner or a small loser. But the controllable outcomes is what attracts me to this idea. I think it's very, very difficult for people to catch a running trade if you're sitting there watching it. And I believe that it's necessary from time to time to offset all the scratch trades and the losses and commissions and all that stuff. To validate your process and put your mind at ease, you need to do this from time to time. It's really hard to do. All right, you're up $300 in the trade. You're like, oh God, I can't let that go back to zero. I mean, I definitely can't let it turn into a loser, but if I let it go back to zero, God, I mean, that's just such a waste. I mean, you have to be able to let that happen. And this is going to tie directly into something I'm going to mention in a moment. But it's my opinion that if you can't adjust to that idea, this is not going to get any easier. All right, I wholly believe that. And this ties into what I'm going to say here now. Okay, this will not work if you crave instant gratification or you're not willing to adjust away from that behavior. If you are bored with small dollar amounts, meaning, if you get into a few contracts and you only get a portion of them filled and you don't get the rest filled, that's just not worth your time, or it's boring to you, you're not getting the action you want, okay, this won't work. This goes back to this giving back open trade equity. If you feel that you must generate a certain dollar amount per day for income or some other reason to make this work, this will not work. It will affect your decision-making ability in too negative of a way. You need to be able to release yourself from that obligation. Is it possible that you start off by, chipping away with a few bucks here or there, and then eventually as time goes on, you get things bigger and bigger to the point where you can trade, normal size or larger size? Sure. I mean, that's the goal. But if you feel that you need to, eke out a certain dollar amount per day for income reasons or for whatever other reason, it's going to be very difficult to make this work. Okay. Again, you need to be willing to go in light, and you can't be compelled to use a super tight stop. You have to have an honest conversation with yourself about maximum risk per day, and use that as part of your decision-making process when it comes to putting a stop in. It doesn't mean that, if you're going to risk $500 or $600 in a day, do it on 1 or 2 trades. You don't have to do it on, 25 trades. Okay, I think you'll be happier if you scale it back. All right, and then beware of chat room FOMO. Okay, chat room FOMO, fear of missing out. Trading on a longer time frame means less activity, means sitting there for a long time. Okay, do something else. Don't look at the chat room. If you need to listen so that you can soak up the analysis, no problem. But the chat room is going to be buzzing with all the trades you're missing. Everyone's going to be like, whoa, I just caught 20 points in the NASDAQ. Booyah, right? I even feel it. I mean, I'm sitting there watching it sometimes, and I feel it. I mean, if I feel it, I can only imagine what you are feeling. Remember, the majority of the people who trade that aggressively on that short of a time frame usually lose. Okay, just a reality. All right, are these people trading for real? Do you see a daily statement every day? Is there some ego in there online? So you'd be surprised. I can't tell you how many times I've seen, Mr. Jones, who I know is my customer in the room, being like, hey, everybody, look at this. I just shorted the, 61.8 Fibonacci retracement in crude, and I made, 38 cents, $380 in crude. And then I go look at the account, and yep, there's 380 simulated dollars. Nothing in the live side, though. All right, you'd be surprised. Don't let it get to you. Focus on you. Okay, you can still soak up the benefits of the analysis, the knowledge. You can still get that. Don't succumb to chat room FOMO. All right. Okay. So we're going to go look at live charts. We still have a little time, so we're going to be done with this in a second. But again, MPD lines. There's no magic. It's basic math. Primarily, I think these are most useful for counter trend opportunities. In some cases, you got to look at the market context and look for, you can see trending opportunities as well. As I said, require context and awareness. This is not something that can just be automated, but it can reduce trade frequency. And I believe that it can reduce these debilitating quick stop outs. I believe that using these very basic lines can foster patience and afford people the ability to catch runners. And this might cut against some of the stuff you've been taught by people who are teaching you how to scalp. And I don't think those people are bad, all right, necessarily. I think that a lot of these people believe what they're teaching is right. And for some people, it might be. But for a lot of people, I just don't think it's a good fit. And again, I'm in this for the long game. I need you guys and gals around for a long time for it to be worth it, for us to do the kind of work we do and to put together these materials and all the extra support and all the stuff we try to do to make, create a better experience. We need people to stick around. So we're going to put material in front of people that we believe has a chance to make that work. Okay, so that's just a quick summary. A couple things about the charting, and again, stick around because I'm gonna go to the live charts here in a minute, because even though the market closes in 5 minutes, there's still some things I want to show. AT charts, for those of you who are not familiar, I'm not going to read this whole thing. We have a web-based charting app now that runs on any device. It's something we've been working on for a very long time. It is becoming immensely popular already. We already have people using this in favor of some of the programs we used to use in the past. Many of which we still support, okay? But this is the direction that we have chosen, and we are already seeing a really positive response from the trading community, from our partners in the education space. Lots of the stuff that you're used to seeing is getting integrated with our program. And again, if you have an iPad or an iPhone or an Android device or a Mac, okay, you can now trade from that and see live charts. I put a really cool video up the other night about, I was at home sitting on the couch with my wife on a Sunday, 2 Sundays ago, when that crude oil news broke. I looked at my wife and I said, crude oil's down $6. And she looked at me like, so? And I pulled up the charts and I actually recorded the screen on my iPhone. I mean, the responsiveness of the feed on this thing it was unbelievable. I mean, even as a proponent of the company, I was shocked at how smooth it was. I'm super impressed by it, and I think y'all will be as well. So it's a great app. And it runs on any program, and it integrates with the platform when it comes to trading. So you'll be hearing more from us about it. Please feel free to explore it, and obviously we love your feedback as well. Okay, a couple of basic things about Infinity, just for the people here who are newer to us. $1,000 minimum for if you only want to trade the micros, $100 day trade margins, $3,000 for a regular account, including $500 on the E-minis, currencies, interest rates, and $1,000 on crude and gold. The Infinity AT Dome is free, always has been. AT Charts, which is the charting program that all this stuff is built in, is free with 10 round trips every 30 days. Otherwise, it's $12. It's optional. So if for some reason you don't want to use it, or you don't feel you're going to do 10 round trips in 30 days and you'd rather not pay for it, you can opt out of it entirely. Okay. Couple just things about why Infinity. I mean, if you meet one of these 4 requirements. Okay. If you are trading with Thinkorswim or TradeStation, if you're thinking about starting futures trading, if you want access to a low-cost, ongoing practice environment, or if you're looking for a place to start over, please consider us. There's going to be some really great stuff that comes with working from Infinity, like the margins and flexibility and all that. That stuff can fit into a spreadsheet neatly. You can evaluate it and all that, but there's going to be a lot of stuff that you can't fit into a spreadsheet. The speed of the platform, it's super lightweight. The Trading Dome uses less memory than one tab of Google Chrome. No joke. I mean, it is fast and it's not going to be held back by your other programs. If you are, for example, a Thinkorswim user and you're getting bogged down every time there's a little bit of movement, or a TradeStation user suffering from, really bad execution, you could just run our DOM right alongside your other charts. No problem. So if that's the way that we're going to get involved in your world here, so to speak, or you're going to let us in, that's perfectly fine. You don't have to relearn all the charts and all that right out of the gate. That's how a lot of people get started with us. So I hope that this sort of event can reinforce why we're a special place, and why this boutique firm is one of the few firms left in our business that can offer FCM owned and operated tech, meaning the company holding your funds actually owns and supports its own stuff instead of outsourcing everything, and still can give people that personal, the personal touch, especially, for example, in the form of, this sort of content. All right. So thank you for coming. Let's flip over to live charts. Again, my email address is pz@Infinity Futures. So if you have like a group of people, if you are interested in working with us, if you are thinking about coming aboard and have questions, please feel free to email me. It's just pz@infinityfutures.com. I would be happy to, discuss with you. All right. So cool. Thank you. All right. So let's do a couple things with the live charts here, just if in the few minutes that we have left. So this is what my screen looks like right now. So let me just make sure this looks good. Everybody can see the chart. So I've got the S&P, I've got the NASDAQ, the Russell, and the Dow here. I want to bring up a little notepad thing that I wrote a little earlier. Where is it? Here it is. Okay, so I'm going to flip to another tab of the S&P that I had open here a little while ago. I drew these weird looking lines. Okay, so let's use today as kind of an example. So this is the S&P open right here. This vertical line is 8:30 in the morning, and this is 9 o'clock. So remember that first hour or first half hour I was saying, okay, maybe you stand aside. Let's pretend that you said you followed that instruction. You said to yourself, okay, I'm gonna hold off on the first 30 minutes. So let's just say you started buying 10 micro E-mini contracts, and I'm going to use the word evenly in quotes because I don't expect people to buy them exactly evenly between X and Y prices. But let's just say that you started buying the S&P and the micro around this area. So the market came close to that lower MPD line. You're like, you know what? I'm going to stick with that. So you put a couple on, or you put one on, and then we get a rally and you don't do anything. And then the market comes back down and you're like, oh my God, it's about to go negative. And oh no, it goes negative. Let's just say that you are thinking, all right, we're now going to touch the MPD line again, and you scale into that 10 lot micro. All right, that is a trade that has already gone for 2 hours. So now you're in this position for 2 hours. Okay, and the total trades you've done is 10 micro contracts. Okay, if you scaled those evenly, roughly between 72.5 and 65, you are now long an average of 10 from this yellow price. So if you started buying them here and then you finish buying them here, you now have an average of all 10 at this yellow line. Now you're in the equivalent of one E-mini S&P. All right, let's just say that you're comfortable with a $600 risk per day. Okay, you're in a 10 lot micro, that's one E-mini S&P, and you're willing to risk $600. That's $50 a point, 12 points, which means you can hold that long position down to 56 3/4 with only a $600 risk. All right, that is an extremely powerful idea. The reason is that look at the margin of error that it gives you. You can maintain a long bias with this kind of a price range and actually have the market double down that same amount of loss all over again before you actually get stopped out. Now, I know there's a lot of people in this room who would be willing to risk $500 or $600 in a day, but most of the people here will do it in addition to 80 commissions. All right, thanks for doing that. Okay, we appreciate it. But again, we believe that if we can keep you around longer without having to do that, that you're going to bring your buddies, you're going to trade for the next 10 years with us. It's way better for all of us if you can last. All right, so this to me is a very powerful example. Of course, we have the benefit of hindsight. Yes, the market could have just tanked lower. There could have been another, more news out of China, or Trump could have said, to heck with whatever, and the market could have continued lower and you get stopped out. Sure, I mean that's possible. But you can also get clever with the weighting. You could have weighted that scale on the lower end of that predicted range. So if you bought a couple contracts around here, but you held off a little bit and then you go in a little heavier, never going higher than what your max position size is, you end up with a lower average cost than even the one that we're showing. So the trade-off is that if you pick up less contracts, meaning you only buy a couple and you don't scale, then if the market rallies, you're in a tiny little trade. That's what I said before about you can't be bored with small amounts. A win's a win. All right. The trade-off though is that, if the market breaks lower, you end up with a nice lower average price that can either get you out of a jam or has the potential to make you more money. So once you get into the trade and you have a stop in place, and the stop for me, it usually will be a fixed dollar amount. So this line down here would represent a hypothetical $600 risk. All right, put a couple orders to scale out around the VWAP, which is the white line, and then take a hike and come back in 3 hours. All right, or do something else. Don't sit there and stare at it. All right, that is the idea here, is that you can peel something off, and the whole trade, lasts in this example, the trade lasts the whole day. You did a total of 10 micro trades. You're not paying that much in transaction fees. You're not sitting there staring at it. Maybe your quality of life is improved in general because you're not, staring at the screen all day. This kind of thing is possible for most people. Most of our customers can handle about this amount of risk. And if you can't, you have to adjust. Maybe you're only going into 5 micros, or maybe you got to spread them out a little further, or whatever the reason is. All right, but the combination of the determinable number of outcomes, the fact that you have a really wide margin of error, which means that if your entry sucks, you can still live to fight another day and possibly even win. The possibility of gain, the predefined maximum number of risk, as I would say in quotes, max risk, the low number of transactions makes this, in my opinion, a generally good idea for most people I engage with. And you've got those fixed number of outcomes. You're either stopped out, you come back and you had a runner like the whole day, like possibly in this case, or you come back and not that much has happened. So that is something that I find to be generally attractive if that is the kind of thing that entices someone who has historically suffered. Okay, the rectangles that I draw, I like to draw the rectangles when I think of the thought, because that's an accountability procedure for me. So if I draw a rectangle that begins here, it means that I started looking at this level around here, around this time rather. Okay, so the beginning of the rectangle on the left is where I started thinking about the price level. So sometimes what I'll do is I'll draw a rectangle going forward like this, so that I always know when I started thinking about this. All right, it's a pretty neat idea, and again, it's like an accountability procedure. And then if you can always just easily extend them further like this. So, to me, this is a good example. There was a pretty decent, hypothetical short here. This happened so late in the day, I'm not sure I would have done anything with it. But, the market was rallying into the close, and, I had my eye on this level, and with a smaller contract, 10 points in the NASDAQ on 1 or 2, 3, 4, 5 micros is nothing. Most people here can afford to do that. So same thing with the Dow. A couple of areas I was looking at earlier, not that many trades are happening. It's just this is what I meant by order staging, is that you're looking at things on a bit of a wider time frame, and you can afford to do that if you're judicious with the positions. And this is, in my opinion, one of the best ways to employ the micros. I think that there are some silly ways to employ the micros. Trading the micro S&P for 3 ticks at a time, forget it. It's a waste of time. It's you're gonna chew yourself up in cost and frustration. No one's gonna want to sit there and trade the micros for 11 hours to make $45. Okay, that makes no sense. But this way, there's plenty of opportunity with the market. The way the markets are moving right now, and the way that you can scale the positions over extended periods of time. You could trade more than one index at a time. You can look at your positions like I showed you earlier. I was saying, okay, I was long 2, 2, 1, and 1, or whatever it was. In my mind, I'm thinking, okay, I'm long about 0.7 E-minis. That, you can easily stay within your risk tolerance using the combination of those contracts. So it's a really, it's a cool idea, I think. And, I hope you can take something out of that. There were some questions that came through about the new charts. The MPD lines are only native to the AT charts, the new web-based charting. So, that's obviously our focus. So if you want to have access to something you see here, if you have an account with us now, just talk to your rep and they can show you how to enable these. It's very easy. Okay. You have CCI and tick and the volume profile on the chart. How do you use them? So the tick, Aubrey, is usually a fading indicator. So if somebody says, all right, how many people here have heard the concept tick fade? Probably everybody. So if you're looking for a fading opportunity and you're looking for confirmation, I think that a high tick reading, for example, if you're looking to go short, would be a nice way to get some confirmation. If you have a sustained, high tick value that just doesn't feel like it's going away, maybe you hold off a little bit, or you ratchet up your entry a little higher than one of those lines. You may miss the trade, but you may save yourself some money as well. So that's one way to use the NYSE tick. The CCI, it doesn't really matter to me what oscillator it is. Sometimes I like to look at an oscillator as also for counter trend sort of confirmation. So if there's a deep move down, a lot of times what I'll look at is I'll say, okay, is the CCI making an extreme low print? If it is, that's usually not something that is sustained for all that long, and sometimes you will get a retrace. So you don't want to clutter things up too badly. I don't think you have to use the CCI. You could probably use a stochastic or an RSI or some other oscillator as well. All these oscillators are, to me, they're all kind of the same. But the general idea is that if you feel like a little extra confirmation is necessary for you to follow your rules, or you want to incorporate something else you already use into this idea, then by all means. Okay. And then the volume profile. Volume profile, I would look at. To me, the volume profile is sort of obvious. When I look at, for example, here's a good example of this. Look how the volume, this volume is low in the Russell, this sort of valley. Well, if you looked at what the market did to generate that volume, it was this area. Of course, this was a fast move down. I mean, and then the market accumulated volume down in this area, so the volume profile is bigger here. I mean, I don't necessarily know that I need to have the profile here. It's it kind of makes me feel safe looking at it, but to me, it's very obvious that if the market were falling this quickly, that there's probably it was probably done, and this fit in this short amount of time, it was probably on relatively low volume. But I suppose that one could say, if you were to see a big spike at a certain price level, then as the market reverted back to that area, you may want to be wary of that. Or if you see very, very little volume taking place at a certain price level, that means the market may be more likely to just kind of like cut through that level on its way back up. That would be one way to utilize a volume profile. So a lot of times when people look at volume profile, they're really just looking for peaks and valleys, and they're looking for areas that were not of much interest to traders to be cut through. Okay, so that's kind of what I'm thinking there. Mark, what does the abbreviation MPD stand for? It stands for maximum permissible deviations. Okay, Inti, how did you get the 4 separate screens? All I did was, these tab together like this, right? So I just grabbed one and just moved it into another free space, right? Inti, my son is your son's age. Oh, right on. Awesome. Okay, David, thanks for the nice comments. Appreciate that. Joe, I don't see the AT charts in the App Store. It's actually a web login, Joe. So at some point there will probably be a native app, on the phone. But for now, all you do is log in via the client portal. So if you're a customer, you go into the client portal, click on the green button inside the client portal to bring up the charts. So if you're opted into the charts, then they'll come up. All right. Okay. Does anybody else? Oh, YouTube. Yeah, Dave. Thanks. Goodness. How could I forget? If you have any questions that I may have missed, this would be a great time to ask, because we'll probably be wrapping things up here. I'm going to bring up the YouTube playlist and I'll post it right here for everybody. Okay, so that's the YouTube playlist. If you go there, please feel free to subscribe to the Infinity Futures YouTube channel. If you click on Infinity Futures here, once you get there, you'll be taken to our main YouTube page, which is where we put all of our stuff. So we have, oh, sorry about that. We have all of our, all of our videos, different playlists. This one here is called Patrick's Corner, Real Talk for Traders. And again, I welcome questions and such, because the more I get, the more content I can put out there that I know is going to be relevant. Because if you're asking me, then odds are someone else is going to be asking me as well. Okay. Thanks, Bob. Appreciate that. The MPD study is not native to any other program, folks. So the only way to make it in some of these other programs would be to like create it yourself. That's one of the reasons why, we like this, this new program. So it just doesn't exist natively in the other ones. All right. Oh, you're welcome. Thank you. Alex, no, those other two companies, Toss TradeStation, we basically compete with those firms, right? So, we're after your business if you're currently trading there, and if you're at one of those firms and you like what you hear, then we'd love for you to give us the opportunity to compete. All right? Yeah, Miles. Yeah, it sure is. Good catch. All right. Awesome. Well, I think that's probably a good place for us to wrap up. Oh, Ron, real quick, the MPD lines based on auto chartist at all? No, they're not. They're not. It's really just the VWAP and then the range of the day. That's it. Those are the only two numbers that go into play. Super, super easy. We have the recording recorded, so it'll be up on YouTube, I'm guessing within a day or so. Hopefully you can come back and watch it if you need a recap. But if of course, we welcome all the questions. All right, excellent. Well, thanks everybody. I really appreciate it. Got a lot of nice feedback. I hope this was useful. I'm looking forward to starting to do these again. I'm really interested in getting good information in front of y'all, and we really do appreciate the opportunity. So, goodness, I mean, if you have questions or there's something you'd like to see covered, please by all means share it with me. You have my email address. It's just PZ. I'll put it in the box as well. PZ@infinitygroup.com. That's me. Please feel free to send me an email. Again, referrals means a lot to us, folks. If you are working with a group or you talk to people in the chat room, kind word here and there would be super cool. All you have to do is pass along whoever you deal with in our office, give them their direct contact info, encourage them to speak directly with the person you speak with. We very much appreciate that. Really goes a long way with a firm, with a firm like us. And the more referrals that come through, the more time that I can spend doing this kind of fun stuff instead of making sales calls. Okay, so really means a lot to us. Thank you again for listening. I'm going to go ahead and read a disclaimer one more time, and then we'll wrap things up. We'll have it up on YouTube. Everybody who's signed up will get a link to the YouTube video, so you'll maybe probably in the next 24 hours. All right? Okay. All right, everybody. Thank you for your time. We'll see you next time. All right? Trading futures, options on futures, and retail off-exchange foreign currency transactions involves substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. All right. Thank you, everybody. See you next time.